Okay, thanks so much, Rick. Well, investors have been busy reevaluating their appetite for risk, and that includes a close examination, really, of stocks and mutual funds in their 401ks. It's now the time to reassess, rejiggle your retirement assets, is it? Well, joining us, we've got Vern Hayden, founder and president of Hayden Financial Group, and also today's guest contributors, Ned Riley and Peter Schiff. Thanks so much for joining us, all of you, of course. So I guess, you know, one of the big questions is, should people right now be moving their assets within their 401k, or should they ride this out?
It depends on how they have their portfolio aligned to begin with. But this, as you said, is a catalyst to re-examine the allocation to see if it's in tune with somebody's risk, because somebody never really knows how much risk they can handle until they get into a crisis. And all of a sudden they realize, I can't stand this. And so they should realign it. And they should look at funds that would provide them with both offense and defense. These are hybrid type funds that can invest in cash, stocks, bonds, maybe foreign, and that sort of thing. And then they should have pure defense and fixed income, short-term stuff like U.S. government securities and that sort of thing, and one good equity fund like Wintergreen with David Winters, so they'll capture the upside.
Diversification being the key. You know, of course, a lot of it's going to depend on your age, how much time you have, what that time horizon is. We've been taking emails from viewers that have questions, of course, and our task force is here to answer them. That's you. Here's one right here from someone who says they have 90% stocks, 10% bonds in their mutual funds. The person says, I plan to retire December 2008. I know I stayed in too long in the high-risk area, but it felt good when the market was hitting 14,000. Sure did. Well, this person wants to know, where should I be investing now? And I want to also point out something that wasn't mentioned in that graphic right there. I've got the email in front of me. The person's 59 years old. Yeah, wants to retire next year.
There's always excess somewhere in the market where greed and stuff is taking over, and that's what's happened. And here, to have 90% in stocks when you're that close to retirement doesn't make sense. So this person might take a look at reallocating so that they're in some very conservative stuff, because I think there are some real problems yet on the horizon. And as Peter really
Peter will tell
out.
you. Peter will definitely tell you. We have no doubt there.
Hopefully this individual...
He's like, go to cash.
Hopefully this individual's in good shape, because I think he's going to have to postpone his retirement for a decade or two.
But he does need a parachute. I don't agree that it's that extreme. But I think that they should cut back and have about 50–60% in fixed income that focuses on short-term stuff.
If it's in U.S. dollars, it ain't going to work.
Okay, we got lots of questions we want to answer today, so I want to get to the next one right here. Another viewer writes in and says, you know, a number of us retirees protected ourselves by investing in CDs. Does today's intervention give you any hope that perhaps we should be moving into equities again? So, you know, market's doing well today. Investors seem pleased by this move out of the Fed. Should people reallocate based on today's news?
Absolutely not. They should reallocate based on their risk tolerance, their time frame, and what their goals are. Not on what's happening today or tomorrow. Don't let the trends eat you up, because you don't know. Yesterday, some people wanted to pull out of the market. Today, they want to go back in the market.
Very
that kind of thing will not work. People will have their portfolios decimated if they behave that way.
Ned Riley, I heard you trying to get in there real quick. What do you think? Should people move based on today's news?
Absolutely not. And I always tell people to avoid the static and the noise of Wall Street. You're investing for 3 to 5 to 10 years. I don't care if you're retiring at 59. You should be expecting to live until you're 85. So I invest according to how long I expect to live. We don't know how much money that person has in the 401k. He may have $5 million, and he can afford the risk of 90% equity exposure. My bottom line is, you take these as opportunities. If markets back off, I'm sorry, Peter, but I believe the U.S. market is attractively priced. I think we'll get 9 to 11% return over the next 10 to 15 years. And the bottom line is, don't invest for next week or next month. I mean, this is a long-term proposition in retirement. I am semi-retired. I live off my my investments in 401k, and I am 75 to 80% in equities right now.
Okay, all interesting stuff. We got to go. I know, Peter, you want to get something in there, but we'll get back to you as soon as we finish this commercial break. Our thanks,
Ned,
of course, to Vern Hayden.
Ned, you got problems, man.
Now you got
Ned's got a couple decades, according to Peter.
Oh, I got 3
1 to 2 decades. I wouldn't start counting your chickens, my man.
Here you go, Dilligan.
No chicken. I eat chicken.
Where's Peter? All right, we got to take a break.
Okay,
we have time.
Lots of fun. All right, another CNBC task force. Welcome back to the call. Wow, what a difference a day makes. The Fed certainly helping things out here today. Right now, we're up about 170 points on the Dow. So what should you be buying right now? We want to go to our guest contributors, see what they have to say on this issue today. We've got Ned Riley, CEO of Riley Asset Management, also Peter Schiff, right here next to me, president of Euro Pacific Capital. Ned, I'm going to start off with you. When you look at this market right now, when you look at the U.S. equity market, where are you putting your money?
Well, basically, and I'll tell you right how my portfolio is structured. I'm buying the S&P 500, exchange-traded fund as the core of my portfolio. I own the QQQQs, which is an index of the top 100 stocks in the NASDAQ. I bought some XLK, which is a technology exchange-traded fund.
You're an index man.
I am an index man because I'd rather spend my time on asset allocation. In XLF, I know, Peter, and that's the financial group, and it is clearly doing poorly this part of the year, but I think over the next 3 to 4 years, it's going to look pretty good.
And the idea being, of course, that financials might be the ones that actually lead us out of this problem right now.
Well, I really do. And I'm focused more on the big banks, the big major money center banks and the big super banks, because I think, one, they have the access to capital. Two, they're going to take market share away from the countrywide financials. Three, I think the disintermediation is going to start working in the other direction where the banks get more business. But most importantly, too, they've got some pretty solid yields, and most of the major banks have not cut their dividends in 30 years. So,
if you're going to invest in U.S. stocks at all, you want to avoid anything that has to do with the U.S. economy, financial services, the consumer. You got to be in the exporters or the natural resources. I wish people would stop talking about subprime. This is not a subprime problem. It's a mortgage problem. It's not just people with bad credit that are going to lose their home equity. They're going to have their adjustable rate mortgages resetting. We're going into a massive recession. You got to steer clear of anything related to our economy.
So if that's the case, if we buy your scenario, what does that mean? What do you buy? Real quick, we're running out of time.
Well, you got to buy foreign currencies. You can buy gold. You can invest abroad. You just got to be in the economies that are going to prosper, not the one that's going down the tubes.
Okay, thanks so much to both of you. Yep. We want to toss it back to Dylan right now over at the New York Stock Exchange.
All right, well, let's take a break here. We'll come back. I mean, what the heck? This conversation's worth continuing. We'll do that. We will do that, getting you through the middle of a tumultuous week on Wall Street here on CNBC. Welcome back. Minute left in the show. 30 seconds to a person. Peter, if we've subscribed to your line of thinking, how will we see your line of thinking validated over the next 6 to 12 months?
I think you're going to see it in the credit markets. I think you're going to see, we've been living on borrowed money as a nation, and that's coming to an end. It's not just borrowing money to buy houses, but to buy cars, to buy furniture, big-ticket consumer electronics, appliances, credit card debt.
So if there's a problem with that, where will we see it?
Well, you're going to see it everywhere. You're going to see it in consumer spending. You're going to see it in financials. You're going to see it in more bankruptcies. Okay. You're going to see it in more problems for loans. This party is coming to an over. We're going to have a huge hangover.
So the consumer spending numbers particularly will be very evidentiary of your thought.
Eventually, they're going to fall off a cliff.
Ned, for growth, what are you flagging?
I'm flagging the continuing involvement of the Federal Reserve. Right now, they've done a little bit to stabilize the market, but I'm looking for a cut, obviously, in the federal funds rate, maybe 0.75% by the end of the year, more liquidity provided to the system. I'm also looking at the consumer from a different perspective, that I'd like to see some spending prevail despite all the things that Peter's pointing out, which are true. The second issue, I have to look at inflation throughout the world. And what the Fed has been wary of, I don't think will prevail. I'm looking for 2% inflation throughout the world.
You're not going to find it.
I literally have 10 seconds a person. Peter, the investment you hold right now you're happiest with?
I don't know. Well, some of my short positions.
What are you short? Short financials?
Yep, some of the mortgage backs, but long term, I love gold, I love commodities, I love foreign stocks, and even though they've gone down recently, I think it's a great buying opportunity.
Peter, Ned, you?
The antithesis. I really like the XLK technology stocks in general.
All right, a pleasure. You both were great today. Thank you, guys.
Thanks.
All right, Trish?
Hey, thanks so much for watching the call. I'm Trish Regan.
And I am Dylan Radigan. Power Lunch. Next, Sue Herrera. And then my good buddy Jeff Mackey, spending time. He's climbed out of the fast money ditches, and he's now living in the big time with Sue Herrera. Power Lunch right now.